Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest news from Strategic Finance, which has posted a higher profit and increased its debenture rates to over 10%. We'll look at the latest retail sales figures and what they mean for interest rates, and we'll check out why the New Zealand dollar remains so stubbornly high. It seems the Belgian dentists and Japanese housewives still love us, even in the midst of global market turmoil. Firstly, we get an update on the performance of one of the biggest finance companies. Strategic Finance has just reported a 21.5% increase in its profit for the half year to the end of December. It has also reassured investors it has $101.8 million of cash on hand and is still growing its loan book and its depositors' funds. However, Strategic Finance is also feeling the pressure in a finance company sector that has lost 14 of its members to receiverships in the last 20 months. Strategic's reinvestment rate was 51% in January. This is down from over 70% before the crisis hit the industry. However, its shareholder funds are strong and its equity to debt ratio stands at 17.4%, which is well above the industry average at 12%. But like other finance companies, Strategic is having to work harder to get depositors' funds. It has also just increased its secured debenture rates over 10% for the first time. Strategic joins Hanover Finance, which did the same thing last week. Finance companies are now in an environment where you can get 9% for a one-year deposit at the government-owned Kiwibank. And it's clear the return being offered by finance companies, compared to what investors can get in the bank, hasn't responded to the perceptions about finance companies being riskier than banks. As this chart shows, the average finance company debenture rate for a 2-year term is about 150 basis points above the average bank rate. That compares with about 200 basis points early in 2004, before finance companies started collapsing. We would argue that gap needs to be closer to 300 basis points, 3%, to justify the extra risk of investing in finance companies. That suggests finance company rates have a long way to rise yet. Next, we have a look at the latest retail sales data for the key Christmas trading month of December. They show that actual retail sales rose 5.4% in December from December a year ago. Fuel sales rose 23.4%, in large part because of higher petrol prices. Electrical appliance sales, however, fell, in part because of the high New Zealand dollar, which has dragged down import prices, and because of the constantly falling price of electronic gadgets. The seasonally adjusted sales growth for December from November was 0.1%, which was in line with market expectations. However, seasonally adjusted sales growth for the quarter from the previous quarter was 1.9%, and that was well above market expectations for a 0.6% rise. Now, this appears partly due to a significant upward revisions for September and November. So what does it all mean for interest rates and the exchange rate? It says retail spending hasn't actually slowed down that much. Taking out the various blips, consumer spending is still growing at an annual rate of more than 6%, which is more than it was through the whole of 2006. The Reserve Bank can take no comfort from these numbers that consumer spending is slowing much. Most of the news in recent weeks show the inflation heat is on the bank. Most expect the Reserve Bank to hold rates when it next decides on March 6, but there is certainly no room to cut anytime soon, and a hike later this year remains a possibility. Finally, we look at why the New Zealand dollar has remained so solid around 79 US cents in recent weeks, despite global market turmoil that you would have thought would have knocked it lower. Many observers say the days of the carry trade are about to come to an end. The carry trade is where investors in Europe and Japan, and we often refer to them as Japanese housewives and Belgian dentists, borrow in their own currency at cheap interest rates and put their money into a high interest rate currency like the New Zealand or Australian dollars. They do this by investing in so-called Eurodashi and Eurokiwi bonds. New Zealand interest rates are between 4 and 8% higher than those in Europe and Japan. That's a mighty big gap and a mighty attractive one at that. Some people have predicted that the massive issues of New Zealand dollar bonds to European and Japanese investors may dry up as they worry about the carry trade. An awful lot of these bonds have been issued in recent years and are now beginning to mature. So a lot of bond issues have to be made simply to fill the gap left by the maturing bonds. The theory is that when the carry trades start to unwind, it will unleash a wave of New Zealand dollar selling, often referred to as the Uridashi tsunami. The interesting thing is that despite the global turmoil in recent months, there have been big Euro-Kiwi and Uridashi issues going on behind the scenes. Much more, in fact, than the maturing bonds. In January, there was $2.06 billion worth of these bonds issued. This more than made up for $1.35 billion of maturing bonds. And this month, the European Investment Bank is issuing a Uridashi bond to raise 845 million New Zealand dollars. That bond issue closes next week and matures in 2010. Also, ANZ is issuing a Uridashi to raise 140 million. That closes at the end of February and matures in 2012. So the carry trade is not dead yet, which is likely to support the New Zealand dollar at close to 80 cents for some time. This will ensure there's plenty of foreign cash flowing into our coffers to pay for our big current account deficit and allow us to continue borrowing to spend more than we earn. You've just got to love those Japanese housewives and Belgian dentists. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Monday.